Thank you very much, and lovely to be back here in Addis after what's been a very difficult 2.5 years for most of us. And it's great to see many familiar faces and to be welcomed back into Ethiopia and Addis. I think we've heard from all the speakers this morning, and I think we take our cue from the Minister, the changes coming to the banking sector. And what I'd like to talk about today is what this means for some of us in the audience, and what to expect over the coming years when we look around the world and we look across the continent. So to begin with, can I have a show of hands how many people here are bankers? Quite a few of you. Great. Well, the good news is that the evidence is that when you liberalize the financial sector, salaries for head office staff in banks almost double because of the competition for quality staff. So there's good news ahead for all of us. The bad news for those of you who own a bank is that there are two classes of local banks, or three classes. Those that go through a difficult period but eventually manage to compete effectively with the incoming banks, those that struggle on their own and destroy shareholder value, and those that sell at a premium to the foreigners who want to get into the market. So you have some very difficult choices to make over the coming years. As many of the speakers we've prepared quite a long presentation, which we don't have time for. So if you can see my name up front there, if you can please follow me on LinkedIn, we'll send the presentation to you. And what I'd like to do now is just talk about 2 or 3 of what I think are the most interesting slides we have. How do we get this thing to move forward? Are you driving for me? Great. So 3 topics. Impact of liberalization, international theory and evidence. What can we learn from our benchmarks in East Africa? And what does this mean for Ethiopia? The international theory and evidence is quite straightforward. I'm sure most of you have covered this previously. Foreign banks have access to capital. They have more stable sources of funding, which they can draw from abroad, and they are able to differentiate their credit portfolios significantly across their operations. So this is why governments and regulators typically welcome foreign banks into the market. What is less well known is that this has sorry, we're going too fast here. This does have some very mixed impacts on the domestic banks. What often happens when the foreign banks come into the market is there's a scramble for good credit. A lot of the stronger credits, the wealthier people migrate to the international banks, and so you have the local banks left with weaker credit portfolios, smaller clients, and poorer clients, and often left with distribution networks, whereas the foreign banks will focus, as we've heard from other speakers, purely on the digital space. Some East African benchmarks. Now, if there's one slide you should look at, this is probably the most interesting slide I have. And thanks to my colleague Tama, who's going to put up his hand somewhere, who is based here in Addis, for preparing this slide. What this looks at is the share of public or state-owned banks, international banks, and domestic banks across your key East African markets. And what you can see is that Ethiopia stands out, as you all know, as having a very large state-owned bank and a growth in some private sector banks, but they're all domestic. If you look at Uganda beneath Ethiopia on the slide, you can see how in 1990, it didn't look too dissimilar to other markets in that over 50% of the banking sector assets were state-controlled. That was Uganda Commercial Bank and the Cooperative Bank. One of those became so non-viable it was shut, and the other was sold to an international bank. And as you can see over the next 20 years, the sector has become almost completely dominated as a result of those privatizations by international banks. So international banks control about 90% of the banking sector assets in Uganda. If you look at Tanzania, a very similar story. In 1990, Tanzania didn't look that different to what Ethiopia looks like today. They also couldn't control inflation, by the way. And you had a state-owned bank which controlled the vast majority of both commercial and retail deposits and accounted for over 90% of the branches in the country. That bank was split up into two banks, and those were part privatized or fully privatized. And what you saw in Tanzania was the international banks coming into those privatizations and growing their share of the market. But a number of local banks did reasonably well. And because neither of those banks were fully privatized, the state remained a shareholder in both of them, you have this blended model where you've got very large banks with international shareholding, but some public shareholding remaining, dominating the market. Kenya has a very different story. Way back in 1990, Kenya already had a banking sector which was largely privately owned. Your state banks in Kenya in 1990 only were about 20% of the market. And you can see that there was a rough split between the international and the domestics, but with the internationals controlling most of the market. This carried on until about 2000. But by 2020, what we've seen is that, well, you can't really see it on the screen I'm looking at, but that the domestic banks were fighting back. The international banks had lost market share. And this is really very interesting, and it doesn't happen in many markets. And it just shows you the strength of innovation and change that we've seen in the Kenyan banking sector. So a very interesting pattern of recovery of the domestic banks happening in Kenya at the moment. The picture of the map shows you just how important international ownership is of the banking sector across the continent. So you can see between 20 and 60% of the assets of the banking sector across the continent are in fact controlled by foreign banks. But you can also see what's going on in East Africa in terms of how different the contribution of the banks are to the sector. So when you look at the level of bank accounts, Kenya stands out as being dramatically better banked than the rest of East Africa, but Ethiopia is not doing too bad in terms of the number of people who have a bank account. If, however, you look at the lower graph, you see a very different picture. You can see that the share of people who, in the donut, who have a debit card, compared, say, if you look at Kenya compared to Ethiopia. So only 4% of the population in Ethiopia have a debit card, compared to, I can't really see the figure from here, almost 40% in Kenya. And then if you look at the branch ratios, which is the number in the middle of the donut, you can see there are way more branches in Ethiopia than there are in any other of the markets. And so you've got a financial sector that has a very, very different level of digitization. And as you can imagine, all of this is going to change very dramatically in the next 5 years. And then I can jump to my last slide before I get into trouble with our able moderator. What does this mean for Ethiopia? Well, as we've discussed, there's going to be a dramatic increase in competition in the sector. And this is very good for the sector and something that we all need to prepare for. So the question to all of the bankers in the room is, how do you plan for this level of competition? How do you secure your people? How do you make sure that your technology strategy is on par with the incoming banks that have been operating in a much more digital environment than you are familiar with for many years? Then there's always the issue of collaboration versus exiting. Can you collaborate? Can you strike deals with international banks that are mutually beneficial? I think the most famous example here is Citibank, which across the continent operates as one branch. It's the only bank that somehow manages to operate as a branch as opposed to a subsidiary. But it strikes partnerships with the bank with the biggest retail distribution network so that it can service its corporate clients. Then technology. Increasingly, if you ask any bank CEO across the world what they do, they say, well, they actually run technology companies. And this is terrifying if you thought you were actually involved in serving customers and making credit decisions, because how do you make sure you make the right technology decisions? And then, as we've already highlighted, we expect to see a surge of mergers and acquisitions. And everyone wants to be the guy who survives, who remains as an independent bank. But that's not always the best strategy for shareholders or for people working in a bank. And then finally, the regulator has an enormous amount of work to do. As banks increasingly become technology companies, and that technology sits on the cloud and involves partnerships with fintechs and a range of different firms, how do you actually regulate those relationships? Central banks, and I think we have the Deputy Governor here, are set up to look after credit risk and make sure banks are solvent and liquid. Central bank supervision departments were not set up to manage technology and operational risk. So there's enormous transformation required in what central banks do and how they operate and how they understand the risks in the financial sector. You know, there's one risk where a bank lends out money, doesn't collect it. There's another risk where something stops working and people can't access any of their money. So very different set of risks. And as we've highlighted early on in the presentation, with the growth in competition, there's often a deterioration of credit quality in the market. And so the central bank has to be very aware of these trends and make sure that the quality of the capital in the banking sector remains up to speed, and the quality of credit monitoring and regulation is up to speed. That's it from me. So I think I even kept on time.